Hello student, in this video clip I will practice how to record and how to report the held to maturity investment with the example of the bonds. As we already discussed during the class, we have three types of bond: the premium bond and discount bond and the par bond. So the held to maturity investment in the bond investment, we assume we hold this bond until the maturity. That's why we say held to maturity investment. Okay, so let's start from the premium bond. What is the premium bond? Right, the premium bond is when the bond issued with the market rate, which is lower than the coupon rate. The bond issuers give us the greater the amount of a coupon than the market requirement. That's why the premium bond price is greater than the par value of the bond. But at the end of the day of maturity, the issuer will return not the price of the bond, 525,000, but the par value, right? Because they already distributed the greater coupon, 8%, than 6% market rate of the required rate of return of the bond. In order to issue the bond issuers just can meet the satisfy the required rate of return, the 6%, but they the issued the 8% of coupon, which is greater than market rate. That's why we say this is the premium bond. So how do we record it? Okay, there we go. The HTM, which is bond investment. We are going to classify this HTM bond investment in the long-term investment because we are holding this bond until the maturity. And then the maturity is about 3 years here. How much is the bond? Right here, 525,000, which is the cost of the investment, and then cash out 525,000. So on December 31st, year one, and how do we record this? Right, the bond up by 525,000, right, and then cash down, right, by this investment. So this is just the exchange between the cash and the bond investment. There's no the transaction here when we purchase. There's no other transaction. If we assume, then the balance out 600,000. Now the second year, December 31st, 1 year later, the market value of bond was 520,000. The annual coupon was received in cash, and the firm didn't choose the fair value option for the investment. Okay, then in that case, we first should calculate the cash, right? The coupon, that is the coupon amount, right? The coupon amount is the fixed income when the investor invested in that bond, the fixed income. How to calculate it? As we discussed during the class, right? Par value, always par value, which is the fixed amount, right? That is the amount, the amount that will return at maturity. Not 525,000, but $500,000. This is par value of bond times. What is the coupon rate? Don't put 6% the market rate. The market rate is to calculate the interest rate, the dollar amount, interest revenue. But here, when we calculate the coupon, we use 8%, right? And then, what is the interest revenue? When the investor ABC company received the interest, which is coupon. Now we need to recognize the revenue, which is interest revenue. When you calculate the revenue, now how do you calculate it? Right. Interest revenue. What is the investment? Now you have to take a look at this interest revenue for the investor's perspective, right? The coupon amount is calculated by, right, the issuer's offer. But here, interest revenue is for the perspective of investor. How much was the investment amount? Right, there you go. 525,000 times how much is the required rate of return, which is the market rate? Yes, 60%. So the interest revenue is 31,500. Now, what is the difference between two? What is the difference between two? Right? The company, the ABC company, purchased this bond and received the greater amount of the interest revenue than the greater amount of coupon than interest revenue, right? So by this amount, HTM held to maturity must be reduced. Okay, so 8,500 is going to be reduced because the coupon amount is greater than interest revenue. That is that was supposed to be received. But when the company, when this bond issuer issued that bond, the coupon rate and the par value was already decided, right? They cannot change. It was bound with that the fixed rate. Then the difference between two is held to maturity is reduced again because the ABC Corporation, the investors received greater cash than interest revenue. So let's put this always ending balance of the prior year is the beginning balance of the current year, right? So we have to start from then on. Now the cash received from the coupon is 40,000, and then interest revenue. Now we have to record here interest revenue, right? This interest revenue, if there's no if there's no other transaction other than interest revenue, now we put this net income here, and then we have to reduce this HTM. Right now, this amortized cost of HTM, the new book value is 516,500. Again, why? Because the interest revenue is 31,500. Again, HTM original investment amount was 525,000, and the market rate was 6%. Right? So the interest revenue that satisfy the investor, the ABC Corporation, is 31,500. But the coupon amount that the company received was $40,000. They received more amount than this, the interest revenue, right? So 8,500 should be reduced from this original cost, and then this 516,500 is now the new net book value of the investment. This net book value of this bond investment is diminishing, and then at the maturity, this bond book value will reach to the par value of 500,000, because that is the promised amount when this bond issuer bond with the par value $500,000. Okay. Now the next, we have to sum these two up. Okay, good. And then next, the market value of bond was 515,000. Again, the market value doesn't matter because held to maturity is following the amortized cost method, not the fair market value method, right? So here, one more time, cash. Okay, let's put just the same. One more time, interest revenue. We have to recognize the second year, and the second year here, the interest revenue and the coupon. How do we calculate coupon? Again, the same. Always the coupon amount is a fixed income, right? So we use par value 500,000 times, right, the coupon rate. Right? This is cash amount received. But actual interest revenue for the investors should record is how much is that now? What is now the investment amount updated, amortized, right? 516,500. Okay, so the principal is now it's reduced. That is new principal, which is 516,500 times what is the market rate, right? The investor's rate is 6%. Then by this difference, we balanced out 9,010. It should be now recorded on the ATM as a negative cost, right? Now let's record this, and HTM always starting from the ending balance of the prior year as a beginning balance of the current year. Right. And then here other revenue. Okay, let's get started. Cash first. Cash amount increased because of the coupon received. Interest revenue is smaller than the coupon received, right? Then this retained earning of the ending balance must be, right, added with this net income. Now HTM, this amount will be, right, minus reduced. Now it's getting closer to the par value, $500,000, which is the amount that will return at maturity. Okay, you guys understand? Okay, this is amortized cost. We started from $525,000 original cost investment, right? But it has been diminished by the difference between the coupon and actual interest revenue, right? Interest revenue. Again, why the held to maturity investment in the premium bond, the original cost has been reduced because the coupon received, actual cash received, is greater than interest revenue based on the market rate. The borrowing rate for the issuer's perspective is only 6%, but the issuer gave that investors the 8%, which is greater than market rate 6%, right? That's why this principal amount is diminishing, and then at the maturity, the par value will return to the investors. Not $525,000, but $5,000 at maturity. You guys understood? Okay. Then here is totally opposite. This the condition is totally opposite, which is a discount bond when the market rate is now greater than the coupon rate, right? In that case, let's assume that $475,000 is held to maturity. So held to maturity bond investment, 475,000, and here cash out. This is totally opposite situation here for 75. Then there's no interest because of the company just purchased this discount bond, right? So, here cash now reduced. Right, shows like that. Okay, then 1 year later, the market value of the bond, $490,000. Doesn't matter. We are not following the market value and market value method under this the amortized cost. So again, we can expect that this $475,000 initial investment original cost will reach getting closer to the $500,000, the par value, right? Because here, when you calculate cash, which is coupon received, right, is how much is that? 500 is the par value, right, times 8%, which is coupon. So $40,000 coupon, but the interest revenue, we want to record interest revenue. We record must be greater than this coupon amount because market required the 10%. Market rate was 10%, which is greater than the coupon rate, right? So the interest revenue, how to calculate it? Right, is 475,000 investment. We have to look at this revenue interest from the perspective of investor. So investment amount 475,000 times, right, the 10% is the market rate. In order to sell this bond, the issuers should satisfy the 10% market rate, not 8%. But when the issuer issued this bond, when the company, the issuer produces this bond, it is already fixed, right? But even if the market, the required the 10%. Then what is this difference? Now here, HTM. Now the difference between this $475,000 and $5,000, that gap should be amortized by the difference between two. So the interest revenue and then HTM and 7,500. This 7,500 must be now added up from this initial investment cost to reach $500,000 at maturity. So let me show you. Here the cash starting point, always we have to put the ending balance of the prior year when you make the several years transaction on the balance sheet. We have to connect from the ending balance of the prior year, right? Then how do you record this cash amount up? Cash, the coupon received, and then interest revenue 47,500. Then this, there's no retained earning, but we add up, right? Then HTM must now increased by this amount. Why it must be increased? Because the investor, the ABC, bought this bond when the market value of bond, market rate of bond was 10%, right? 10% is the required rate of return, right? But the issuer, the XYZ, the bond issuer, the issuer gives $40,000 coupon, which is fixed, right? But they had to meet this 47,500 interest. They required this actual interest, but they at most gave this the cash coupon amount $40,000. Where is 7,500? Right, this 7,500, the unpaid, this interest should be added to the bond here from 475,000. Then the bond now initial investment now increased by 482,500, and then at the end of the maturity, this bond initial cost will meet $500,000 because $500,000 is the par value at which the bond issuer will return to the investors, not $475,000. You guys understood? Okay. Then let's just make sure. Okay, then we balanced out. Then last year, one more time. The same way, the 40,000. Now the interest revenue, how to calculate it? This HTM now, right, increased, right? Or you can just put this number, right? 482,500 times what is the market rate? Market rate is 10%, right? So the difference between two is, right, this amount. Now this 8,250 should be added into this bond investment, so that the difference between 475,000 and 5,000 par value, that gap is amortized. Okay, the cash amount increased by the coupon received, and okay, we have to start from the ending balance always. Okay, let's get started from there. Here, this amount now should increase by this HTM. Now getting closer to $500,000. Interest revenue is 48,250. Then if there's no other transaction, now this retained earning now increased. Then now we got this balanced out, right? Okay, good. Okay, the par value investment is just simple. Why? Because par value investment is when the market rate is equal to the coupon rate. So there's no difference between coupon amount received and interest revenue recognized, because the par value is the same as the investment amount of 500, and the coupon rate 8% is the same as the market rate, the investors market rate of 8%, right? So in that case, there's no difference, just we can add the $40,000 again here, HTM bond investment 500,000, right? And the cash is $500,000. The same. We have just one line, cash amount. How did you calculate it? Right, $500,000 par value times 8% coupon, and interest revenue also the same, 500,000, which is investment amount. This investment amount, right? This investment amount times how much was the rate of investment, right? Still 8%, the same, exactly same. So 1 year passed, the same interest revenue and same amount of this, right? Because the cost of this HTM doesn't change, right? Doesn't change. So now it's very simply to update it. There's 500,000. There's no the coupon yet. Oh, sorry, the interest, because they just purchased. Then total asset. Oh, we have to reduce this cash, 500,000. So the sum of all balanced out. And then second, we have to start from the ending balance the same way, bond payable and the common stock, and then retain the earning, and the cash amount up by 40,000, and then interest revenue up by 40,000. And if there's no other transaction, we must add this 40,000 into the retained earning, right? And then sum of this balance exactly increased by the cash received. And then retained earning also increased by the interest revenue, $40,000. Then let's continue from the ending balance of the prior year to start the beginning balance of the current year. Then we put this also the same interest revenue, Then we accumulate, we retain into the retained earning, and then this cash amount should be increased by the coupon received. Doesn't matter. The this bond the cost changes because the it's nothing to do with this the amortization, because amortization is nothing to do with this par value investment, because the par value $500,000 doesn't change. There's no amortization because again the coupon rate and then par value and the initial investment and the coupon rate and the market rate of investment is the same. So this amount will be now the par value, which is the amount of the return, right? So we just balance that out. Okay, this is how we record and report the held to maturity, a long-term investment. So we'll continue the liability. In the liability, we'll continue the bond payable, how to issue. Now, the bond held to maturity investment is the investor's point of view. We record this a long-term investment asset side. Now, for the perspective of issuer, how to record their the bond payable on the long-term liability. And then we'll practice that as well. Okay, see you guys in the next video clip. Bye bye.